Usually when you sell something, you expect the price tag to actually mean what it says. You know, you list your house for, say, $500,000, somebody buys it, and after a few predictable fees, you know roughly what's hitting your bank account.
Right. Yeah, it's pretty straightforward.
Exactly. But imagine selling something you've spent, I don't know, your entire adult life building, only to find out that you are walking away with 30 to 50 cents less on every single dollar than the headline price you actually agreed to.
It is a staggering reality check. I mean, it really is. And for a lot of founders and entrepreneurs, it's a reality check that arrives entirely too late in the process to do anything about it.
Right, which is just heartbreaking. And that 30 to 50% evaporation of wealth, that is exactly what we are focusing on today. We are doing a deep dive into a really, really detailed guide called Business Exit Planning: 7 Ways to Keep More.
A fantastic resource, by the way.
Oh, absolutely. It's put together by Davies Wealth Management, which is a fee-based fiduciary advisor out of Stuart, Florida. And our mission today is to extract the most critical, actionable mechanisms from this guide. So whether you are a business owner staring down a future sale or, you're simply fascinated by the underlying mechanics of high net worth wealth strategy, this deep dive is tailored directly for you.
Yeah, because the stakes here are just astronomical. We're not talking about putting a little extra away in a diversified portfolio. We're talking about a single, highly complex transaction that will likely define the rest of your financial life and potentially the financial lives of your heirs, too.
Okay, let's unpack this, because the guide draws a very stark line right out of the gate between ordinary financial planning and business exit planning.
Yes, very different animals.
Right. I mean, ordinary planning is what most of us know. It's that slow, steady drip. You contribute to a 401k, you rebalance a portfolio, maybe harvest a few tax losses at the end of the year. It's gradual. But business exit planning takes decades of that kind of slow burn wealth creation and just compresses it into one single high stakes event.
And that compression, well, it creates incredible opportunity, but it brings massive concentrated risk. A mass market approach simply does not work for high net worth exits.
It just breaks down at those numbers.
Yeah, exactly. If you are selling a business valued anywhere from, say, $1 million to $50 million or more, your tax exposures are entirely different than someone selling a $500,000 local shop. The fundamental mistake these high net worth owners make, and we see this all the time, is a matter of timing. They wait until a buyer is already sitting across the table with a term sheet.
Which means your leverage is already gone, like completely gone.
Oh, 100%. The ideal planning window is 2 to 5 years prior to a sale. Once a letter of intent is signed, the tax code drastically narrows your options, and the opportunity to save hundreds of thousands or even millions of dollars completely evaporates.
Wow. So since this planning requires a multi-year runway, let's jump into the very first critical structural decision that dictates everything else. And that is how the actual sale itself is constructed.
The foundational piece.
Right. Because you'd think a sale is just a sale. I give you the business, you give me the money. But the guide reveals this massive tug of war between the buyer and the seller right at the starting line.
Yeah, the conflict really comes down to the mechanics of asset sales versus stock sales. In any acquisition, the buyer and the seller have fundamentally opposing tax motivations.
Naturally.
Right? So buyers almost universally push for an asset sale because they want what is called a stepped-up tax basis in the specific assets they're acquiring.
Wait, let me stop you there just to make sure we really understand the mechanics of why the buyer cares so much about that. When you say stepped-up basis and asset sale, they are basically itemizing the company, right?
Exactly, breaking it into pieces.
Right. They are buying the physical equipment, the customer lists, the intellectual property piecemeal. And they do this so they can depreciate those assets over time. So basically, depreciation allows the buyer to artificially reduce their taxable profit on paper for years to come. The government is essentially subsidizing their purchase through future tax breaks.
You've hit the nail on the head. The buyer wants to parse the company out into specific buckets for those future deductions. But the seller, they're looking at a completely different set of tax rules.
Is this like buying a used car? Like, the buyer wants to itemize every scratch and worn tire to get a deal or a tax break on the parts, but the seller just wants to hand over the keys and, pay one flat tax rate on the cash they walk away with.
That's a great way to think about it. Sellers almost always want a stock sale. In a stock sale, the seller is not selling individual assets. They are handing over the legal entity itself, the LLC or the corporation.
And the mechanism there is that the gain on a stock sale is typically taxed at long-term capital gains rates, which are significantly lower than ordinary income rates.
Right, much lower.
Because in an asset sale, if the buyer allocates a huge chunk of the purchase price to something like inventory or certain equipment, the IRS taxes the seller on that portion at ordinary income rates, which could be nearly double the tax burden.
Yeah, the tax friction is palpable there. The buyer wants a detailed, itemized receipt to maximize their future tax deductions, and the seller wants a clean, unified transfer of the entity to protect their lower capital gains tax bracket.
But if the buyer holds all the cards, meaning, they are the ones bringing the giant checkbook to the table,
Yeah.
how does the seller actually win this standoff? Do they just fold?
Well, this is where that multi-year runway and having a highly skilled transaction advisory team pays off. A skilled advisor doesn't just argue for a stock sale on principle.
Right, they need numbers.
Exactly. They quantify the exact dollar difference for your specific business. You sit down at the negotiation table and say, look, we understand you want an asset sale. However, our tax modeling shows an asset sale will cost us an additional $1.2 million in taxes compared to a stock sale. If you insist on an asset sale to get your depreciation benefits, well, the top line purchase price needs to increase by $1.2 million to make us whole.
Oh, wow. You use the underlying tax mechanics as a tangible negotiation lever.
Precisely.
You force them to pay for the tax break they are demanding. That is brilliant. And speaking of tax mechanics, the guide mentions something incredibly technical here that I want to dissect, the Section 1202 Qualified Small Business Stock Exclusion.
Yes. Section 1202 is perhaps the most powerful yet somehow overlooked provision in the tax code for founders.
Really?
Oh, yeah. If your business is structured as a C corporation and you have held your newly issued stock for more than 5 years, you might qualify for this exclusion. The mechanism here is that it can potentially exclude your 100% of your eligible capital gain from federal taxes.
Wait, I want to make sure I am hearing that correctly. 0 federal capital gains tax on the sale of a multi-million-dollar business.
Under the right conditions, yes. 0. The limit is typically the greater of $10 million or 10 times your adjusted basis in the stock. So if you meet the criteria, you could potentially walk away with up to $10 million in gains completely free of federal tax.
That's unbelievable.
It is, but the rules are draconian. The business must be an active trade or business. So holding companies don't count, and certain industries like hospitality, farming, or professional services are explicitly excluded.
And the biggest catch seems to be the C corporation requirement. Because, most small businesses start as LLCs or S corporations for the pass-through tax benefits. You can't just realize you have a buyer lined up, call your CPA, and switch to a C Corp the month before the sale to dodge the taxes.
Exactly. The 5-year holding period prevents exactly that. By the time you know you are selling, it is way too late to restructure for Section 1202. This is why exit planning is a multi-year endeavor.
Wow. Okay, here's where it gets really interesting. Let's assume we've negotiated the structure. The next massive hurdle the guide points out is the payout itself. Because getting a wire transfer for $10 or $20 million sounds like the ultimate dream, but taking that payout as a lump sum is actually a dangerous tax trap.
A huge trap. A lump sum triggers a cascade of tax consequences. If you receive the entire purchase price in the calendar year of the sale, your entire capital gain is recognized immediately.
Right.
And not only does that massive spike in income instantly push every dollar into the absolute top federal and state capital gains brackets, but it triggers secondary taxes.
Specifically, the 3.8% net investment income tax, or NIT.
Exactly. That NIT kicks in when your modified adjusted gross income crosses a fairly low threshold. It's around $250,000 for married couples. By taking a $10 million lump sum, you guarantee that almost the entirety of your payout is subject to that extra 3.8% penalty tax. You are needlessly volunteering to pay more.
So the mitigation strategy here is an installment sale. Instead of taking the giant check on day one, you structure the deal so the buyer pays you over, say, 3, 5, or 10 years. And the mechanism is that you only recognize the capital gain proportionally as you receive the principal payments each year.
Right, you're smoothing it out.
Exactly. By smoothing out the income, you stay in lower tax brackets and potentially keep large chunks of the payout underneath that NIT threshold.
And beyond just income tax brackets, smoothing the payout keeps your annual income manageable enough to execute other long-term strategies, like Roth conversions, which would be mathematically impossible if you took a massive lump sum in year one.
But I have a major concern with this. If you spread the payments out over a decade, you are essentially acting as An unsecured bank for the buyer.
This raises an important question, yes.
Right, you are loaning them the value of the business they just bought from you. What if they run the company into the ground in year 3 and just file for bankruptcy?
That is the ultimate trade-off. It is known as counterparty risk. The tax savings of an installment sale are entirely irrelevant if the buyer defaults on the note. You never engage in an installment sale without a highly creditworthy buyer and, more importantly, without aggressive security arrangements. You need collateral, personal guarantees, or liens on the business assets so that if they miss a payment, you have legal recourse to take the keys back.
The guide also brings up earnouts in this section, which is kind of a variation on future payments.
Hmm.
That's when a portion of the purchase price is tied to how the business performs after you leave. But there's a specific hazard here where an earnout can suddenly mutate from capital gains into ordinary income. How does that happen?
Yeah, so earnouts are frequently used to bridge a valuation gap. The seller thinks the company's worth $15 million. The buyer thinks it's worth $10 million. They compromise at $10 million up front, with a $5 million earnout if the company hits certain revenue targets over the next 2 years.
Makes sense on paper.
It does, but the hazard lies in the IRS's interpretation of your post-sale involvement. If the earnout is tied to you sticking around and providing mandatory consulting services to hit those metrics, the IRS can recharacterize that earnout. They will argue it isn't a capital gain from selling a business asset. It is simply deferred compensation for your labor.
Ouch. And suddenly that $5 million is taxed at your highest ordinary income rate, plus payroll taxes, completely defeating the purpose of the exit tax plan.
Which underscores why your transaction attorney and CPA must be in absolute lockstep when drafting the purchase agreement.
Man, so an installment sale helps spread the tax pain out over time. What if your goal isn't just to delay the tax, but to permanently shield that wealth while also building a philanthropic legacy? That's where we have to look at the pre-sale moves that Davies' Wealth Management Guide highlights, specifically charitable remainder trusts or CRTs.
Yes, for business owners who already possess charitable intent, the CRT is a phenomenal mechanism, but the sequence of operations is incredibly strict.
Let me walk through the mechanics of the CRT to make sure I have this right. Step 1. Before the sale is finalized, you transfer a portion of your business interest, say 20% of your LLC shares, into the charitable remainder trust.
Correct.
Step 2. The business is sold to the buyer. But because the trust itself is a tax-exempt entity, when the trust sells its 20% share, it pays zero capital gains tax.
That tax-exempt wrapper is the magic of the CRT. The trust retains the full untaxed proceeds of that portion of the sale to invest and grow.
Then step 3. Because you irrevocably gave that asset to a charitable vehicle, you receive a partial charitable income tax deduction in the year of the sale, which you can use to offset other taxes. Step 4. The trust is required to pay you an income stream, usually a set percentage of the trust's value for the rest of your life. And finally, step 5. When you pass away, whatever principal is left in the trust goes to the charities you selected.
The mechanism provides a massive upfront deduction, eliminates the immediate capital gains tax on the contributed shares, and secures a lifetime income stream. But you glossed over the most dangerous word in your breakdown before.
Right, the deadline. The guide emphasizes the anticipatory assignment of income doctrine.
The IRS is acutely aware of owners trying to dodge taxes at the 11th hour. If you wait until a binding letter of intent is signed, or the deal is effectively done with no meaningful contingencies left, you cannot suddenly transfer shares to a CRT.
It's too late.
Exactly. The IRS will look at that timeline and rule that the gain was already realized by you. They will force you to pay the full capital gains tax before treating it as a charitable donation. You must execute the CRT while there is still material risk that the deal might fall through.
Wow. And I'm looking at this section on donor-advised funds, or DAFs, and I'm trying to wrap my head around their specific utility here. It looks like you're essentially using a massive charitable deduction from a DAF to surgically wipe out the tax hit of something very specific in the sale, like a non-compete payout. Is that the primary mechanism?
That is a primary use case, yeah. Often in a sale, the buyer will allocate a portion of the purchase price to a non-compete agreement to ensure you don't immediately open a rival business.
Sure.
But non-compete payments are always taxed as ordinary income. By funding a DAF with highly appreciated stock right before the sale, you generate a massive charitable deduction in that specific tax year. You then apply that deduction directly against the ordinary income generated by the non-compete, effectively neutralizing the most painful tax hit of the transaction.
Charity is an incredible shield, but what if your primary goal isn't philanthropy? What if it's building a multi-generational family legacy? This brings us to estate planning and transferring wealth to your heirs before the sale artificially inflates the size of your estate.
The legislative landscape for estate planning is currently very deceptive. Under the federal framework, specifically the provisions set by the One Big Beautiful Bill Act of 2025, the federal estate and gift tax exemption is a staggering $15 million per individual or $30 million for a married couple.
With exemptions that massive, a lot of business owners selling a $10 or $15 million company might look at those numbers and think they don't even need to worry about estate planning. I mean, they are completely shielded from the federal tax.
What's fascinating here is that they are shielded at the federal level, but they are walking blindly into a trap at the state level.
Oh, really?
Yeah. Many states have their own independent estate taxes, right, and the exemption thresholds can be significantly lower, sometimes as low as $1 million. If you sell your business for $15 million, you might owe zero federal estate tax when you pass, but your heirs could be staring down a multi-million-dollar tax bill from the state.
So the goal is to move the value of the business out of your estate and into your kids' hands before the liquidity event happens. And the mechanism the guide highlights for this is the grantor retained annuity trust. I read through this section, and the mechanics sound almost like putting your company into a financial time machine.
A financial time machine is a very apt way to describe a GRAT. Let's break down the mechanism. You take a portion of your business stock and transfer into the GRAT today, while it is still valued relatively low pre-sale.
Okay.
The trust is designed to pay you back the exact value of what you put in, plus a modest mandatory interest rate set by the IRS, which is known as the Section 7520 hurdle rate.
So if I put $5 million of stock into the DRATA, the trust is legally obligated to pay me back my $5 million over the term of the trust, plus that IRS hurdle rate, let's say it's 5%. Because I am getting my initial value back, the IRS considers the taxable gift to my kids to be essentially zero.
Correct. But here is where the time machine activates. 6 months later, you sell the business. That stock you put in the trust for $5 million is suddenly liquidated for $10 million. The trust still only owes you your original $5 million plus the 5% interest.
Meaning that the extra $5 million of explosive growth from the sale stays in the trust for my heirs, and because it grew inside the trust wrapper, it passes to them completely free of estate and gift taxes. I told the IRS the company was worth X, I locked it in, it sold for Y, and the IRS acts like that massive appreciation never happened to my estate.
Exactly. The excess return above the IRS hurdle rate vanishes from your taxable estate. But again, valuation timing is everything. You cannot wait until the buyer has set the purchase price to fund the trader.
Let's fast forward. The legal battles are fought. The sale is structured. The GRATs and CRTs are funded. The wire transfer clears. We turn to the final piece of the puzzle. What happens on the Monday morning after the deal actually closes?
Well, first, a very strict clock starts ticking on Strategy 5, Qualified Opportunity Zones, or QOZs. If you have realized a massive capital gain, the government offers a unique incentive to reinvest that capital into economically distressed communities. But you only have a 180-day window from the date of the sale to move those funds into a Qualified Opportunity Fund.
Why is the government offering this, and what is the actual mechanical benefit to the seller?
The government wants private capital flowing into areas that need development real estate or new businesses in designated lower income zones. In exchange for tying your money up in these illiquid projects, they give you a three-tiered tax benefit. First, you defer paying the capital gains tax on your business sale until the end of 2026, or whenever the current legislative deferral period ends. You get to keep your money working for you instead of sending it to the IRS immediately.
And if you hold the QOZ investment for a certain number of years, you get a step-up in basis, reducing the original tax you owed. But the biggest benefit is on the back end, right?
Yes. If you leave that money in the Opportunity Fund for at least 10 years, any appreciation on the new investment is entirely tax-free.
Wow.
Yeah, if your QOZ real estate project doubles in value over a decade, you pay zero federal capital gains on that massive profit when you finally sell it. It is an incredibly aggressive tax shield, but it requires accepting long-term illiquidity.
That brings us to Strategy 6, post-sale wealth deployment. Moving beyond just the tax code, there is a profound behavioral reality shock that hits the owner. I think about this like a massive oak tree versus a sprawling garden.
Oh, I like that.
Right. For 30 years, an entrepreneur's wealth is like an oak tree. All the roots, all the risk, all the growth is concentrated in one single massive organism. They understand every branch of their company. Then the sale happens, the oak tree is chopped down and turned into liquid cash. Suddenly they have to manage a sprawling garden, dozens of different asset classes, public equities, fixed income, private credit. The mechanics of how you tend to a garden are fundamentally different than how you grow a tree.
That is a phenomenal analogy. The transition from a highly concentrated business owner to a diversified, affluent investor changes every risk metric you have. You go from worrying about payroll and supply chains to worrying about sequence of returns risk, tax-efficient asset location, and replacing the monthly salary you used to draw.
And there are unexpected traps in that garden. The guide points out a detail that truly shocked me regarding Medicare limits.
You are referring to IRMA, the income-related monthly adjustment amount.
Yeah.
If you sell your business in your late 50s or 60s, that massive capital gain spikes your modified adjusted gross income for that specific year. Medicare looks at that spike, and because their look-back period is 2 years, that single liquidity event can trigger surprise premium surcharges for your Medicare Part B and Part D for up to 2 years after the sale. It illustrates how a business sale creates shockwaves through every tiny corner of your financial life.
The other hazard of having all that liquid cash in the garden is the psychological temptation to just go plant another oak tree right away. Founders get bored. A perfectly optimized, diversified portfolio feels agonizingly slow to someone who used to run a company. The urge to take $5 million and dump it into speculative angel investing or private equity just to feel that entrepreneurial adrenaline again is massive.
The behavioral urge is completely understandable, but it requires strict fiduciary guardrails. You have to intellectually separate your security bucket from your risk bucket. You can absolutely allocate a portion of your wealth to exciting, high-risk, illiquid investments, but only after mathematically guaranteeing that your core lifestyle, your healthcare, and your legacy goals are permanently insulated from failure.
Which brings us to the final structural necessity, recognizing how incredibly complex all of these intersecting mechanisms are. I mean, the Section 1202 exclusions, the tax-exempt CRT wrappers, the GRET time machines, the 180-day QOZ window, the Medicare surcharges. You cannot navigate this alone. You need to assemble the Avengers of exit planning.
The roster of professionals required is non-negotiable. You need an M&A attorney to negotiate the purchase agreement and build the legal firewalls. You need a CPA with deep transaction experience to model the actual tax consequences of every offer. You need a business valuator or investment banker to market the company and create competitive tension. And you need a specialized estate planning attorney to draft the irrevocable trusts.
But looking at that roster, they all speak entirely different technical languages. If the M&A attorney negotiating the asset versus stock sale isn't communicating perfectly with the estate attorney drafting the GRET, the entire mechanical structure collapses. Who actually runs this team?
If we connect this to the bigger picture, that is the role of the fiduciary wealth advisor. They act as the integrating quarterback. A firm like Davies Wealth Management isn't just waiting around to manage the liquid portfolio after the deal closes. They sit in the middle of the pre-sale chaos. They ensure that the M&A attorney's deal structure perfectly feeds into the CPA's tax models, which dictates the timing of the estate attorney's trusts, all while ensuring every single move aligns with the owner's ultimate retirement and legacy goals. They translate the different technical languages so nothing falls through the cracks.
So what does this all mean? The ultimate takeaway for you from this Davies Wealth Management Guide is that selling a business is not a single point in time. It is a complex, multi-year sequence. It is the culmination of your life's work. To capture the full value of that work, to avoid losing 30 to 50 cents on the dollar, the planning architecture must be built years in advance. Waiting for a buyer to knock on your door is the single most expensive mistake you can make.
That summarizes the financial architecture perfectly. But I believe there is a final, unwritten implication derived from all these strategies that every founder must ponder. We have spent this entire deep dive analyzing the financial exit plan. We've mapped out the trusts, the tax deferrals, the income replacement. But equally vital is the psychological exit plan.
Oh, that is a fascinating pivot, the human element behind the spreadsheets.
Consider the reality of a founder. When your identity, your daily routine, your intellectual challenges, and your entire social circle have been strictly defined by the title of CEO or founder for 3 decades, who are you on that first Monday morning after the paperwork is signed and the money clears? Financial wealth is only one half of a successful exit. The other half is doing the deep introspective work to figure out what you are retiring to, rather than just focusing on what you are retiring from.
Without a psychological plan, all the tax savings and CRT income streams in the world will not prevent you from waking up and feeling utterly lacking in purpose. It's about designing your next chapter, not just funding it. Keep exploring these concepts, keep planning years ahead, and above all, stay curious. We will see you on the next deep dive.